Delayed U.S. job data was released today. There were job losses in October in the U.S., but gains in November. And the unemployment rate rose to 4.6%, the highest it's been since September of 2021. For more insight, let's go to Olu Omodunbi. He's chief economist at Huntington National Bank. Thanks for joining us today.
Thanks for having me.
So the job losses, as I understand it, are in part connected to layoffs of federal workers. But why are we seeing them now and not months ago when first announced?
Yeah, so overall, it was a mixed jobs report. It presented a mixed picture of the U.S. economy. On one hand, we saw the unemployment rate rise to a four-year high. On the other hand, we saw faster private payroll growth. To your point, we saw a big decline in federal government employment. This is due to DOGE cuts. So many of the DOGE cuts announcements were made earlier this year, and many folks took deferred resignation offers. So many of those folks are now getting off payrolls.
Okay, so the unemployment rate move is mostly as well due to less demand for labor. Does seasonality play a role at all here?
Yeah, so I think with the employment data, we always need to look at what's happened over the past couple of months. It tends to be volatile on a month-over-month basis. What we are seeing in the labor market is some cooling. So we're seeing some cooling in demand. We're seeing softer demand due to restrictive monetary policy. Interest rates are still moderately restrictive. That's weighing on several sectors, particularly the manufacturing sector. And tariff policy uncertainty is also leading to softer demand for jobs. So, we're seeing softer demand, and, we think that that's likely to extend through 2026.
Okay. One of the broader measures looks at sort of discouraged workers, those working part-time by choice, and that's up to 8.7%. So what does this tell you about the labor market?
Yeah, so you're talking about the U6 unemployment rate. So that's just one of many indicators which just captures the slower momentum in the labor market. So the U6 unemployment rate captures folks who are part-time for economic reasons and folks who have just stopped looking for a job, folks who are discouraged. And, we're seeing several signs of cooling in the labor market. Job growth has been concentrated in just a few sectors this year. The healthcare sector has been a big driver of job growth. And also just due to weaker labor force expansion. So due to the restrictive immigration policies, the deportations, those are weighing on labor supply, and that's also weighing on the broader labor market.
Let's talk about manufacturing because that moved down again. Washington wants the sector to grow, of course. It's been very focused on that in the early part of the administration. Is this tariff related?
It's partly tariff related. Tariff policy uncertainty is definitely a factor. Another factor is restrictive monetary policy. The manufacturing sector is an interest rate sensitive sector. So think of purchasing durable goods, whether that's RVs, cars, boats. Most of those items are financed, and with high interest rates, there is weaker demand for durable goods in the U.S. Now, another factor that's playing a role is weaker global demand. The Chinese economy, for example, has faced challenges over the past couple of years. China is a big buyer of U.S. durable goods, and with slower conditions in China, that's also weighed on the manufacturing sector. But the great news is that we think that there will be improved conditions next year. The Fed has cut rates by a total of 175 basis points since the beginning of last year. We think that that will be a boost to the manufacturing sector next year. And also, there are several provisions from the One Big Beautiful Bill Act. We think that will be a boost to the manufacturing sector in 2026.
Okay, you mentioned earlier healthcare and a lot of the job growth coming from that sector. Why has that sector remained resilient throughout?
So there are a few reasons. So first, an aging demographic. We're seeing the retirements of baby boomers. That's creating just stronger demand for healthcare services. And also just due to the fact that there's just more access to rapid technology advances in the healthcare sector. So many folks are able to, do tests and find out information about their health conditions more so than before. That's leading to demand for healthcare. And another important factor is just strong consumer balance sheets. As consumers are getting wealthier, that's they can spend more on services, including healthcare services. So all those factors are driving the demand for healthcare workers.
Yeah, we do have to remember that money and how the consumer is doing will affect their health care. We don't worry about that as much, right, on this side of the border. You talked about rate cuts, and you think it'll be an improving environment for manufacturers in the U.S. next year. Is that because you expect a series of cuts or a deeper cut next year?
So our base case is for 1 to 2 rate cuts in 2026. We don't think the December jobs report moves the needle for a January rate cuts. The Fed has cut rates by 75 basis points this year. It cut rates in September, October, and last week. We think that the Fed will, take a wait and see approach over the next couple of months for a few reasons. First, inflation has been accelerating in the wrong direction. So we're seeing faster inflation. And also, the Fed will want to see just the effects of all the cuts over the past couple of years on the U.S. economy. So our base case is for 1 to 2 rate cuts, so 25 basis points each, a total of 50 basis points next year at max. But we think that over the next couple of months, we think that the Fed will be patient, and we think that the bar to cut rates is high at this point.
All right, Olu, I'm going to leave it there. Thank you for joining us. Olu is chief economist at Huntington National Bank.